What's going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. My name is Alex Savanovich. I work at Spoonbill Partners, LLC. I am a trader and an investor. I've traded stocks, bonds, derivative products, you name it, and we've probably traded it. Public markets, private markets, anything and everything. This week was a bit of a quiet week. We had a couple of interesting things happen, but because of the holiday on Friday, it's Juneteenth on Friday, so there's no markets open in the US at least on Friday. So it's just been a little bit quiet and obviously a little bit of a dead period with earnings wrapping up a few weeks ago. So we don't have a ton to talk about today, but there were for sure, like I said, a few exciting things that we're going to discuss. And so without further ado, let's jump right on into them. First things first that I want to discuss, as of the recording, today we are recording this episode on Wednesday. And so that means the Fed would have had their meeting today. It was a little interesting for sure. It was Kevin Warsh's first meeting as the head of the Federal Reserve. There was a couple surprises in the meeting. We're going to go through it in detail, what exactly was the surprise, and then a couple of nuanced items that I wanted to discuss. So the first thing, let's get the surprise out of the way. I don't think anyone, I've discussed it on this show, but I don't think a lot of market participants expected the Fed as a whole to be as hawkish as they were. I think, if you've been paying attention to inflation and what the market's been doing, there's been no reason to cut rates. There's been sort of a reason to maybe stay the same. But hiking slash staying the same was, I think, the vibe. But I don't think anyone expected to this degree that the Fed was going to be as hawkish as they were today. The 2026 dot plot jumped 40 basis points and is now sort of pricing in a rate hike. 9 of the voting members now back rate hikes for 2026, which is more than before. Now, yes, I think the market, if you were watching the tape today, tape gap down on that, and I think they were reacting to this increased level of hawkishness. But as the day progressed, the market found its bid again and then sold off promptly into the close. Now, why do I think we had this sort of reaction? I don't think it has much to do with the quote unquote hawkish Fed. I think that was mostly expected, sort of, by most participants that there wasn't going to be a cut this year. What I think is going on is Kevin Warsh means business. It's nice to see the leader of the Fed actually want to take the reins and get some control back. And he doesn't really care for all the communications and chitter chatter that some of the past Fed chairs have. There's been sort of a regime change. So there's not going to be any more forward guidance. The presser and the statement was notably brief, a lot shorter than ones we've received in the past from Powell. And in the presser, Kevin Warsh refused to answer questions that Powell typically would answer. And so I think this combination of we now have a Fed that might keep the market on its toes a little bit, spooked investors just a tad. And Warsh sort of alluded to this. I'm paraphrasing a little bit here, but he basically said, I don't want to spoon feed answers to the market. Now, another notable thing was that these summary of economic projections, the SEP that you'll see referred to often if you follow financial markets whatsoever. Typically, all the voting members at the Fed contribute to this SEP dot plot. And Warsh said, waste of time. No reason. There's no value in it. Again, I'm just sort of being comical here with my words. He didn't actually say that, but the fact that he didn't contribute to the SEP, I think, shows his hand and tells us that he doesn't really care for it. So the Fed has basically, when we take all this into consideration, turned a little more hawkish. I'm not really of the opinion that it was any more than expected. I think I sort of priced that in and expected us to be a tad more hawkish for the balance of the year. But maybe some people were caught off guard by that. So you have that, and then you have the fact there's not going to be a whole lot of guidance or, for lack of better terms, telegraphing of what the Fed's going to do, as was the case when Jay Powell was the Fed chairman. Now, why is this such an issue? Why did markets react so negatively at the end of the day? Well, I've only been doing this job for 7 to 8 years, but I would say for the better part of the 20th and 21st century, markets have appreciated in value, not solely because, but a large factor of the appreciation in asset prices, specifically US stock market asset prices, i.e., the price in stocks, has been a function of Federal Reserve chairs and just the Fed in general, telegraphing what they're going to do with monetary policy very specifically. And so if you're an active manager, if you're someone who trades stocks or bonds or any product in the US, and the Federal Reserve of the United States of America is telegraphing very obviously what the interest rate pathway for the next 6 to 12 months is going to be, you can more safely make assumptions about what trades may work slash may not work. Maybe you'll want to borrow more and lend out more. Maybe you'll want to borrow less and sort of keep your lending book tight, depending on what the spreads might look like. There are countless examples, but I think what the point I'm trying to make is that when the Fed is very specific in their signaling and their communication for projections on the future, it produces perverse incentives, and the outcomes are people take on riskier behavior because it's one less thing they need to count when you calculate all the risks before you make an investment decision. So if I were to make this a little more mathematical, when you try to value some asset, you have to use a discount rate. And if the discount rate is, let's say, X for the past 20 some odd years, and you chose a discount rate of X with the understanding and assumption that the Fed is always going to telegraph with some degree of certainty what they're going to do for the next 12 months to 2 years. Now that you don't have that certainty, and Kevin Warsh has basically said, I don't really care to communicate what we're doing in the future. I don't want to spoon feed the tape. Now your discount rate has to be a little larger, i.e. The picture that I'm trying to paint here is that you need to factor in a slightly larger degree of risk to every decision that you make in the financial markets, and you might not be so incentivized to take on the risks that you once did as a result of a Fed who does not want to telegraph as much as they once did. And so what does this lead to? You see the sell-off that happened at the close today, and I think we're looking at a new Fed here. Like I said at the beginning of this section, it's a bit of a regime change, and I think it's going to be very interesting to see how the rest of the year plays out and the rest of Kevin Warsh's term as the Fed chairman. So the hawkish tone change, take it or leave it. Some might say it was a surprise. Some might say it was a little more hawkish than they expected. I personally don't think so, really. But the regime shift, I think, is going to be a big deal for investors because we're changing speeds now, how we do things at the Fed, and it's not the norm of what the last 20 years was. It could make for a little bit of a bumpier ride as an asset allocator. All right, that's enough about the Fed. Didn't have too much to say there, but I did think the regime shift thing was an interesting one to talk about because it's something different from what we've seen in the past. Let's move on to segment number 2. I did one of these a while ago. I think I did a couple of them actually, where I discussed some really questionable analyst calls. And today I read one that just made me face palm. I couldn't believe what I was reading. I literally had to screenshot the note and save it for later for when I was making my notes for this podcast episode. So I had made some notes over there on the computer just so I could nail down the facts of how dumb this was. So again, as always, I'm not going to call it the analyst. I'm not going to call it the firm that this analyst is from. I'm just going to give you the call and let you laugh at how silly this was. So an analyst raised their price target on Intel from $65 to $100. Okay, that's fact number 1. They also reiterated their neutral rating, market perform rating, neutral rating. It's all the same thing. The stock currently, I only punched it up a few times today, but I saw it trading around 120, 121. So that's where the stock's trading today. The last week or so, it's been between 110 to 120. It's been consistently over $100. So their price target is obsolete automatically because for the last 10 days, the stock's been above that level regardless. Intel is up 225% year to date and is up nearly 500% the last 12 months. This is a horrendous and lazy call. They have been neutral rated for that entire run. The entire 500% gain, they have sat on a neutral rating with a $65 price target and watched the stock go higher and higher and higher and higher, past 100 and even higher to 120. And all of a sudden today, with the stock at 120, we're going to raise the price target to 100. Really? I'll give you a little bit of price target raising history on this name from this analyst. April 2025, their price target was $21. April 2026, a year later, price target was raised to 60. Then they raised it to 65. Meanwhile, the stock's been trading above wherever they raised their price target to. And then today, all of a sudden, as he watched the stock trade from wherever it was when he raised it to 65, the stock's traded to 120, essentially done a doubling, and he raises the price target to 100. When he initiated the $21 price target, he said the stock was rated a neutral. So you watch the stock. When you rated it, when you said the price target was $21 and it's traded higher almost every single day since April of 2025. It is now 6 times where you said your original price target was, and you've stayed neutral the entire time. How wrong have you been? It's ridiculous. So effectively, his model is just being dragged like a dog that doesn't want to go on its walk, dragged higher with wherever the stock goes. And for whatever reason, he doesn't want to upgrade this name. I get it. I have my own qualms with Intel and not wanting it to be rated a buy. I understand that it's overvalued. You can't be an analyst and recommend a stock at neutral and raise your price target the way that you have just because the stock is trading up and not admit that you were wrong. You've been wrong for over a year. So how do I read this? Classic case of an analyst getting run over by a crazy run up in price and then sort of quietly in the middle of summer here when, in a shortened week, there's not a whole lot of people paying attention. Like I said, it's been a quiet week. Volumes have been down a little bit. There's not a whole lot to do. I didn't even actually trade today. There wasn't a whole lot happening. I was just sitting here watching the markets, trying to find some ideas, but nothing panned out. But it's a quiet day. And so you chose a quiet day to sort of just sneak your price target raise in there so your original number doesn't look so absurd. I mean, if you have a PT of 100 on a stock that's trading at 121, it doesn't look that bad. You're never going to nail it exactly. But sitting there with the 65 at neutral for however long, it starts to look a little bit ridiculous. And some of us start to scratch our heads and wonder why the heck they're paying you the big bucks. And it also tells me that they might not really have the, for lack of a better term, the coconuts to make a conviction call. If the stock rolls over from here, you can say, oh, it was neutral rated, it was sort of right. And if the stock continues to rip, at least his price target was 100, so he doesn't look absurd. It's really just insurance on your career. You just kind of want to save your skin, save your tail. I got to refrain from using swear words. There was a couple that I wanted to use there, but it is just so ridiculous, so silly, and that makes zero sense, just like the title of the pod. So I had to include it in today's episode. So enough about Intel, enough about silly analysts. Let's move on to the next topic I wanted to discuss, which is, I don't think we could have an episode today without discussing the absolute exuberance I'm witnessing in SpaceX. So SpaceX options launched on June 16 or June 17, I think it was yesterday or today. 1.8 million, I'm just going to read off my computer so I don't mess up these numbers. 1.8 million contracts traded on day one. That's $2.8 billion in premium. Shattered the single stock options first day volume record. And just to put it in perspective, obviously the company's named Meta now, but when Facebook did their IPO and options started to trade, that was the original record. And on that day, they traded 365,000 contracts. So SpaceX demolished them by a factor of 5. Now, if you remember on last episode, I can't remember actually if I discussed the actual IPO pricing. No, because by the time I recorded the episode, SpaceX had not gone public yet, so we didn't know officially where it was going to open, etc. So obviously they priced the stock at 135. That's where Elon wanted to price it. Stock opened for trading at 150, so there was some decent deal premium there. And then yesterday the stock's at 200, up about 49% in 3 days. And to make matters worse, to make this whole thing crazier, when the stock got to 200, the market capitalization of SpaceX surpassed Amazon and Microsoft. And I want to say, I think I was reading somewhere today, I was discussing with someone, I'm going to get these numbers wrong, but Microsoft's revenue number is something like 10x SpaceX's. So for them to be in the same stratosphere in regards to market cap absolutely boggles my mind and makes zero sense. And that's just on revenues. Bottom line, they lost $8.7 billion last year. Now, I can already hear all the pundits and the Elon followers, or the Elon cult, I should say, coming after me and being like, you just don't understand the value proposition of SpaceX. You don't get that it's a growth company. Dude, I sit here and watch stocks all day. You could go ahead and call me a loser because it's literally all that I do for all day. I get up at 2:30 in the morning and I sit here till 1 p.m. And then even after 1 p.m. when I'm making these episodes, I'm still reading about the market and I'm going on Barron's, I'm going on Wall Street Journal. I know what a growth stock is. I know what a value stock is. I understand that a growth stock might not always be profitable and that the value derivation process is a slightly different. There might not be dividends for you to draw a valuation base case on. There might not be cash flows for you to sort of come up with some valuation based on cash flows. I understand that the multiples have to be a factor of the revenues or some other metric, and that sometimes if the total addressable market in some future technology that's maybe still in the proof of concept phase, sometimes you're going to apply a crazy multiple. And I've seen how the stock market operates when when Tesla's talking about robo taxis that aren't even a thing yet or barely a thing yet, and we apply some crazy multiple to them, and then the market rips the stock just because Elon owns the company. I get it. I get that some crazy multiples exist out there, but this is on like another level of absurdity. The company, like I said, makes no money. And is trading with the likes of Amazon and Microsoft with the Magnificent Seven. And so the point I'm trying to make of all of this is that it truly, truly, truly is a sign of the times that we are in currently. We have like a barely public company, like they just went public last week, and it's a money losing company at that, valued at almost $3 trillion based on this week's prices. Record smashing, speculative option trading and volume. And I'm going to draw it all back together here. Some people who maybe are bearish or more fundamental approach driven, they might hear what I'm saying and be like, that totally makes sense to me. I want to be short SpaceX. I would caution you and say, pump the brakes for just 1 second. As much as I hate where SpaceX is trading, as much as it makes absolutely zero sense to me to apply a multiple to a business line within SpaceX that makes $0 today, if anything, it loses money. To rip the stock the way that it has been has got nothing to do with fundamentals, and to short a stock solely on fundamentals is a very, very dangerous thing, because as we've seen in the last few years, the retail community in the market is a force to be reckoned with. They are serious. And when there is a cult like name like SpaceX, and you have this cult like leader like Elon, you could find yourself on the other side of a really, really bad short squeeze. I'm not going to sit here and say that SpaceX is going to go to 1,000 this year, but I don't think it's completely out of the question, given some of the things I've seen in this tape, that SpaceX gets to 300, 400, 500 by the end of the year. Just because the retail community and even some of the institutional community is so crazy and cult-like for this name and this guy. On paper, shorting looks like a slam dunk. It makes sense. The value, the valuation and the fundamentals are completely dislocated, disconnected from reality. But I'm going to repeat to you something that someone very intelligent repeated to me. Fundamentals don't matter when momentum and a specific theme are red hot. This is the single most important lesson from this episode. If there is anything you can take away from this episode, ignore Kevin Warsh, ignore the Intel call. But if there's one thing you can take away from this episode, is what I just said about SpaceX. If you are going to short something like this, you need to have a stop loss amount. You need to have that stop order in case things go against you, because this is not one you just want to keep averaging down or averaging up in the case of short selling. And now I don't want you to take that and think, okay, Alex, well, should I be long at these levels? No, absolutely not. Just because I said the stock might go to 500 doesn't mean it will. It could get cut in half to 100 by the end of the week if something goes wrong. I mean, look at Cerberus. That's exactly what happened to Cerberus after the IPO. All I'm saying is take the prudent steps to find names in the market where there is legitimate value to be had, where there's a misunderstood story, where a stock is ripping, but the prospects for that company, or something about that company that is a really huge deal and it's not fully pricing in that fact. I'm just saying there's other opportunities in the tape that aren't SpaceX right now. I don't think it's a good short because the thing could rip to infinity, but as someone who has learned from very intelligent people in this community about taking fundamentals and price action hand in hand to come to a decision whilst also employing sound risk management practices, all of those things in combination would lead me to say, just don't touch this stock. If you were lucky enough to own it pre-IPO and you have a great exit now, perfect, man, take your exit. But it's not a buy up here, but nor is it a short. That's my opinion. And that is my personal opinion. I don't give opinions to anyone who listens to this show. Like I say in the disclaimer after the episode is done, none of this is investment advice. This is all my opinion and what I would do. I do not advise or manage anyone who listens to this. If you think SpaceX is a buy or sell or whatever your opinion is, you follow your opinion. These are just my opinions. So I think in essence, the play isn't to short the bubble or buy the bubble. It's to recognize the dynamics, learn from it, understand it. So when you see something like this cooking in the future, you know how to react and you understand what is going on because we are witnessing history being made, I think. And with that, I'm going to conclude the episode. Thank you so much for listening to That Makes Zero Sense, the podcast. Like I said, my name is Alex Savanovich. I was the host today. I hope you have a fantastic Friday and an even greater weekend. Make sure to follow us on Instagram, YouTube, and TikTok. Take care, and I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.